In this lecture, we are going to discuss first, structure of the financial system, second, financial crisis, third, central banks and the conduct of monetary policy, fourth, the international financial system, fifth, banks and other financial institutions, sixth, financial innovation, seventh, managing risk in financial institutions. Structure of the financial system. The financial system is complex, comprising many types of private sector financial institutions, including banks, insurance companies, mutual funds, finance companies, and investment banks, all of which are heavily regulated by the government. If you wanted to make a loan to Apple or Amazon, for example, you would not go directly to the president of the company and offer a loan. Instead, you would lend to such companies indirectly through financial intermediaries, institutions such as commercial banks, savings and loan associations, mutual savings banks, credit unions, insurance companies, mutual funds, pension funds, and finance companies that borrow funds from people who have saved and in turn make loans to others. Financial crisis. Financial crisis can be defined as major disruptions in financial markets that are characterized by sharp declines in asset prices and the failures of many financial and non-financial firms. Also, financial crises have been a feature of capitalist economies for hundreds of years and are typically followed by the most serious business cycle downturns. From 2007 to 2009, the US economy was hit by the worst financial crisis since the Great Depression. Defaults in subprime residential mortgages led to major losses in financial institutions, not only producing numerous bank failures, but also leading to the demise of Bear Stearns and Lehman Brothers, two of the largest investment banks in the United States. Note that the result of the crisis was the worst recession since World War II, which is now referred to as the Great Recession. Central banks and the conduct of monetary policy. The most important financial institution in the financial system is the central bank, the government agency responsible for the conduct of monetary policy. Monetary policy involves the management of interest rates and the quantity of money, also referred to as the money supply, which is defined as anything that is generally accepted in payment for goods and services or in the repayment of debt. Also, because monetary policy affects interest rates, inflation, and the business cycles, all of which have a major impact on financial markets and institutions. The international financial system. The tremendous increase in capital flows between countries means that the international financial system has a growing impact on domestic economies. Also, whether a country fixes its exchange rate to that of another is an important determinant of how monetary policy is conducted. Whether there are capital controls that restrict mobility of capital across national borders has a large effect on domestic financial systems and the performance of the economy. Also, what role international financial institutions such as the International Monetary Fund should play in the international financial system is very controversial. Banks and other financial institutions. Banks are financial institutions that accept deposits and make loans. Included under the term banks are firms such as commercial banks, savings and loan associations, mutual savings banks, and credit unions. Also, banks are not the only important financial institutions. Indeed, in recent years, other financial institutions such as insurance companies, finance companies, pension funds, mutual funds, and investment banks have been growing at the expense of banks. And so, we need to study them as well. Financial innovation. Financial innovation, the development of new financial products and services, can be an important force for good by making the financial system more efficient. Note that improvements in information technology have led to new financial products and the ability to deliver financial services electronically in what has become known as e-finance. Also, financial innovation shows how creative thinking on the part of financial institutions can lead to higher profits but can sometimes result in financial disasters, which is called the dark side of financial innovation. Managing risk in financial institutions. In the past 10 years, the economic environment has become an increasingly risky place. Interest rates fluctuated widely, stock markets crashed both here and abroad, speculative crises occurred in the foreign exchange markets, and failures of financial institutions reached levels unprecedented since the Great Depression. And to avoid wild swings in profitability and even possibly failure resulting from this environment, financial institutions must be concerned with how to cope with increased risk and how these institutions make use of new financial instruments, such as financial futures, options, and swaps to manage risk, of course.